Hey folks, Dan Frio here with your market update for May 9th, 2024. So if you're out there and you're contemplating buying a house this year, what are your main focuses in on? You're trying to figure out, is your area a good place to buy or rent? Okay. But then you start looking at interest rates and you're like, every day I look, rates are all over the map. So what I'm trying to do today is explain to you guys why there's such volatility in the markets and the data that we have today that's going to just add to that confusion. So without further ado, let's get over to it. So what you're seeing right here, these are the top 6 programs people use when they're buying their first house. Now, these aren't my rates. Okay. These aren't any individual bank's rates. What these are is Mortgage News Daily right up there. They do a fantastic job for us. They survey lenders all over the country and ask them these 5 questions. They say, if you're buying a house and it's a single family home and going to be your first house, what would the rate be? Well, these aren't the rates just yet. What these rates are, these represent people that have a 780 credit score and they're putting down 25%. Now, hardly anybody we work with that has a 780 credit score and is putting down 25%, but that's you. That's basically what your rate is. If that's not you, I'm going to give you all my information at the end of this video. I'm a mortgage loan officer. I'm licensed in all 50 states. Love to help you if you're trying to navigate this market. But in today's video, what we're trying to explain is why the market's doing what the market's doing. So we have the Fed officials. They're talking and they're all over mainstream media right now, and they're affecting the markets right now. And then we have this great information that just popped out this morning was initial jobless claims spiked to the highest level that we've seen since almost last year at this time. And the markets are applauding. Why? You might say, okay, Dan, people are losing their jobs, but the markets love this. Why? What's inflation? The Federal Reserve thinks, if we have more and more people losing their job, they won't have money, and then they won't be able to spend. But there's tons of repercussions with that. Also, what you got to look at is rates, interest rates in general are probably 2 or 3 times higher than where they were, say, 3-4 years ago. Okay, so if you're a corporation that has a massive load of debt and you have to refinance that debt, your costs are going to explode. So you might have to let go people just because of that. But let's take a deep dive into the economic calendar that we have this week. I'm going to explain a lot of this stuff to you. And this week is full of information, so it's a good training tool. So let's go first off to Monday. Monday we had FOMC. That's FOMC means Federal Reserve person. They sit on the Federal Reserve. They're a member. And Williams spoke. Now, he's on the neutral side, and he comes out and says, some things out there. So let me explain one thing to you. There's when you're looking at Fed members, that you have to understand what they are. Are they hawks? Are they neutral? Or are they doves? Now, let me explain these to you because it's very important. A hawk is always thinking that rates need to be higher. They're like, okay, we need to keep rates higher for longer. We might even have to keep increasing rates. Neutral, they kind of just take the data as it comes in and they make their decisions off of that. The doves always seem to see, well, rates need to come down because we need to spur the economy. So you have to pay attention which one of these members is actually talking in the media that day because, again, if they're a hawk, well, it's not going to be very good for the markets. If they're a dove, it might be pretty good for the markets. So that's what we're going to try to dissect right now. So if we go to the economic calendar, we had Fed official Williams speaking on Monday. That didn't really move the markets. On Tuesday, we had Fed official Kashkarian talk. You guys know, or if you watch my videos on a daily basis, he is hawk. So he came in and said, I wouldn't take off the table additional rate increases. And that kind of screwed up the markets in general. The nice thing through here is I want you guys also to pay attention. Some of these auctions. Now, these are Treasury auctions. Okay, I pay attention to these because I'm trying to figure out, is there enough investors out there that gobble up all this debt that we have? And how do I focus in on that? Are people having to pay, or investors having to pay a higher yield on this debt to gobble up all this massive debt that we have out there? So the first thing is on the 3-year auction, they did go up. They went, the last previous auction got 4.54 in yield. The yields went up to 4.6. Might not seem like much, but these, we're talking, could be millions and billions of dollars in Treasury notes right through here. Consumer credit, that is also, a lot of people are saying, consumers are just massively adding to their debt load. Yes, some reports are showing that, but these reports are actually showing it's starting to really taper down. So that's actually really good news, saying the consumer is starting to slow down. All right, we have oil. We're not going to talk about oil, Cushion Oil, Atlanta Fed. This was a shocker. Now, Atlanta Fed came out and they said the Atlanta area, or their segment of the country, they had a GDP growth. The last reading was 3.3. It was expected to stay at 3.3. It came in at 4.2. So that means the economy in the Atlanta section of the Fed's control, the Atlanta section, is actually doing pretty good. Okay, so then you have the 10-year auction, another one. Let's pay attention to this. Last reading was 4.56. It came down to 4.4, so meaning there was enough people to gobble up those notes at a lower yield. Now, here's today's data that we have. Initial jobless claims. Last reading was 1.76. It was expected to come in at 1.79. It actually came in at 1.785. That's continued claims. My apologies. So continued claims are staying steady. Okay, here's the surprising, or here's the shocker. Initial jobless claims. Last reading, 209, was supposed to increase to 212. It went to 231. 231. Okay, so now it's showing us the job numbers are starting to retract. Is this going to increase the unemployment rate? Because if we get to 4%, the markets are going to rally. But let's go to more of the context that we have through here. We have FOMC member Daly speaking today. He's neutral, so I'm not really concerned about what he says in the market, and then we're going to have the Fed balance sheet. Then tomorrow, it's a slew of information. We have FOMC Bowman speaking. They're neutral as well, so I'm not worried about that. But you can see right through here, FOMC members, they're all over the media talking, and everything they say is going to be kind of emphasized. So let's get to the overall market right now. Here's the headlines. U.S. initial jobless claims increased to the highest level since August. That's not good news, and every market, every advertising agency has all that in there. It doesn't matter if you go to CNBC, Market Watch, or everything. It is a huge data on telling us that, employment is starting to get a little bit worse. All right, so the next thing we want to go to is 10-year treasuries. Here's where I talk about the Fed officials. 10-year treasuries rise as investors consider remarks from Fed officials. And those are the Fed officials coming out this week, especially Kashkarian, who came in and said rates might have to go higher. And a lot of the other people on the Fed don't really hold that position. All right. Let's see there. Dow rises, putting index in straight month. Okay, let's skip through there. And then Fed Collins, she's not surprised on the welcome to. So Fed Collins came out yesterday and she kind of reiterated what Kashkarian said, saying we're going to keep rates higher for longer. I'm not quite sure she said we need to raise rates, but that's where Kashkarian, the Fed official, earlier in the week came out and said, that, and that's what spooked the market. So based on this data, what the heck's going on today? Well, we go over to my nifty predictor right through here. This tells me what in the heck mortgage rates are going to do. What is it? Okay, that is actually a bond. It's a mortgage bond that trades on Wall Street. You might even have this in your portfolio, your retirement portfolio. So how you figure out what in the heck's going on with mortgage rates, you watch what's called the MBS. And if you want access to this, if you're a mortgage advisor, you're a loan officer, I'll have MBS, the link down below. You can subscribe. I think it's like $38 a month. This thing is fantastic. So if you're in the mortgage industry, you got to have this stuff. But we focus in on right here. Why? Okay, this bond, mortgage-backed security bond, the yield on this thing is the biggest component of your mortgage rate. Okay, so we pay attention to this bond. How do you read it? Well, you just pay attention to the price. Okay, if the price goes up, yields or rates come down. That's all you need to know. Well, look at it today. We're up 3 ticks. It's not really going to do anything to the market. But if we go to a 5-day chart, look at this thing. Well, let's go to a 2-day chart. The 5-day chart was crazy not too long ago. Well, you can see this massive move right through here. So if you see through here, this was, when was it? April, a couple weeks ago. And then you had this massive move up to here. All this time, rates were coming down. Okay, what am I expecting right now? Well, I'm expecting rates to ease just a little bit. This news is going to compound through the economy. It's going to compound through Wall Street and investors. So they're going to applaud that there's people losing their jobs. Okay. Fed officials are now probably in the next couple of weeks, maybe at the next meeting, come back and saying, okay, some of the data is really starting to come in favorable. Okay, so what did we see so far? We see the mortgage bonds getting gobbled up on Wall Street with not having any excess yield. And you have the jobs numbers coming in line to where the Fed wants. Now, this might put pressure on you and me, consumers, in our pocketbooks because more people are going to get let go. But it is going to, I guess, help the economy overall in general based on the Fed easing inflation. That's one of their main components of what they're tackling right now. So that, without further ado, I'm expecting mortgage rates to just stabilize right now. And as the data comes in, I'm going to have to defer to the Fed. As the data comes in on a daily basis, we're going to monitor it to figure out what in the heck's going on with mortgage rates. So that's my report for today. Who am I? What do I do? How can I help you? Well, first off, if you've already got a loan and you've locked in, you're stuck. And as you see these rates coming down, you might be like, what can I do about this? Well, we have a tool up here. It says a loan estimate. If you got a loan estimate from your lender and you're locked in and you can't really do anything about it, send it to me. It's right up through there. Send the loan estimate, click it, you'll upload your loan estimate in there. What I'm going to do is I'm going to analyze that versus what we might be able to do. So what am I and who am I? Well, I'm a mortgage lender. I'm a mortgage broker. I'm licensed in all 50 states as well as Puerto Rico. And we're set up with, at this time, we kind of pulled back some of the investors that we were using. We have about 50 lenders that we're working with right now. So how does this benefit you guys? Well, instead of calling 50 different places, you can call me. It's one application, one credit pool, and we're going to shop you over 50 different lenders. Okay, so that's what we do. So if you've already locked in, use the loan estimate tab. If you haven't locked in and you're kicking the tires right now and need help, hit the apply now button. You're going to be launched out to a system to put in your application, and we also set up a consultation with you guys at that time to do a one-on-one with you, not to hard sell you. It's just to answer all your questions. And then last and not least, is if you're out there and you're like, Dan, I got the income, I got the credit, I don't have the money for a down payment. What can I do? Check the grant finder up there. It's going to search grants for you right through here. You're going to answer, I think it's 6 or 7 questions, and it's going to let you know if you qualify for grants all the way up to $7,500 that are forgivable right when you walk out of the closing. So that's our report for today. So thanks so much for watching, guys.